Most traders with $150 think their problem is the account size. They're wrong. I've watched traders blow through $10,000 accounts in weeks, while others quietly compound $150 into 5 figures over 2 years. The difference isn't capital, intelligence, or even strategy. It's something most will never admit. They're treating trading like a lottery ticket instead of a business with single trade profit margins. Here's what nobody tells you. Richard Dennis started with $1,600 and built hundreds of millions, but not by risking big or trading often. He averaged fewer trades than most people think, with rules so boring they'd put you to sleep. That's the part the highlight reels don't show. The millionaire traders aren't the ones chasing 50% weekly gains. They're the ones comfortable making 3% and walking away. By the end of this video, you'll understand the 4 mental frameworks that separate traders who survive from those who self-destruct, and why your $150 might actually be your biggest advantage right now. Let's start with the one mindset shift that changes everything. Welcome to Trader's Bible, the quiet room for market mastery. Let's get into it. Here's the thing about small accounts that nobody wants to say out loud. The problem isn't that you have $150. The problem is that you don't respect it. And if you can't respect $150, you'll never respect $150,000. I know that sounds dramatic, but watch what happens when most traders open a small account. They see it as play money, something they can afford to lose, so they risk 30%, 40%, sometimes 50% on a single trade, because it's only $150. They convince themselves that aggressive risk is justified because the account is small. But here's what they're actually doing. They're training themselves to be reckless. They're programming their brain to treat capital like it's disposable. Now compare that to the trader who treats their $150 like it's a seed. Not money to spend. Not money to gamble with. A seed. You don't eat the seed. You don't throw it around carelessly. You plant it in the right conditions. You protect it from threats. And you let it grow at its natural pace. This isn't poetic language. It's a fundamental shift in perspective that determines whether you ever scale beyond small accounts. Because the habits you build with $150 are the exact habits you'll carry into $2,500, $15,000 and beyond. The market doesn't care about your account size. It cares about your behavior patterns. Let me show you what this looks like in practice. Take 2 traders. Trader A has $150 and sees a setup. It looks decent, not perfect, but close enough. He's bored. He's been staring at charts for 2 hours with no action. So he enters with a $75 risk, because if he wins, he'll make $150 and double his account overnight. It feels justified. It feels like the fast track. Trader B has the same $150 and sees the same setup. But his rule is simple. Risk 2% per trade, maximum. On $150, that's $3. The setup isn't perfect, so he doesn't take it. He waits. 3 days later, his exact setup appears. He enters with his $3 risk. If he wins, he makes $6. That's a 4% gain on his account. Most people would look at that and laugh. $6? What's the point? But here's what they're missing. Trader A, if he loses twice, has $37.50 left. His account is nearly gone, and his emotional state is destroyed. He's now in desperation mode, trying to make back what he lost, which means he'll take even worse trades. Trader B, if he loses 10 times in a row, still has $126. He's bruised but alive. More importantly, his mind is intact. He can continue following his process without the psychological damage of a blown account. This is what separating your identity from your account size actually means. You're not trading to get rich this week. You're trading to build the mental infrastructure that can handle real capital when it arrives. The traders who successfully scale from small accounts to large ones all share this one trait. They treated their first $100 the same way they treat their 100,000th. Same rules, same discipline, same respect for risk. Warren Buffett built his fortune on this principle, and so did Jesse Livermore before him. The numbers change, the zeros multiply, but the mindset stays identical. And that's the secret nobody wants to hear because it's not sexy. It doesn't promise overnight results. It promises something better. Survival long enough to compound. Now let's talk about the second framework. And this one makes most traders uncomfortable because it requires you to redefine what productivity means. In any other job, productivity is action. You send emails, you attend meetings, you complete tasks. The busier you look, the more productive you seem. Trading destroys people who think this way, because in trading, the most productive thing you can do is often nothing at all. I call this ruthless patience, and it's not what you think. It's not the ability to hold a trade for 5 extra minutes. It's not sitting through a small pullback without panicking. Ruthless patience is standing in front of the market, watching price dance exactly where you want it to go, and still refusing to pull the trigger, because the setup doesn't match your exact criteria. Most traders can't do this. Their hands start itching. Their brain starts whispering, "Just take it. It's close enough. What if you miss it?" And so they enter a trade that's 80% valid instead of 100% valid. Then they wonder why their win rate is terrible. Here's what they don't understand. The market is designed to trigger your impatience. Every candlestick is an invitation. Every price movement whispers urgency. And if you're not ruthless about your patience, those whispers become commands and you obey them without thinking. I read about a trader in 2003 who had a maximum of 4 trades per month. Not 4 trades per week, 4 per month. 1 month, he waited 23 days without taking a single position. On day 24, his setup appeared. He entered, managed it perfectly, and made more in that one trade than most overactive traders made all month combined. When someone asked him how he could wait that long, he said something that stuck with me. "If the market will still be here tomorrow, why should I rush today?" That line contains everything. The challenge is that waiting feels like doing nothing. And doing nothing feels wrong when you're supposed to be working. Your brain associates productivity with activity. So, you break. You enter too soon. You chase setups that almost meet your rules. You sabotage yourself because sitting still feels like failure. But ruthless patience isn't passive. It's active waiting. It's a conscious, deliberate choice to protect your capital until the exact conditions you require are present. This requires mental strength that most people don't develop because society rewards speed, instant results, quick wins. Trading rewards the opposite. There was a legendary commodity trader in 1982 who made hundreds of millions but only traded about 15 days out of the entire year. People assumed he had some secret indicator or mystical edge. His edge was simpler. He knew his setup so well that he could identify exactly when they appeared. Every other day, he did nothing. He described the waiting as watching paint dry. But when his trade came, it was like stepping in front of a moving train with perfect timing. That's ruthless patience. Waiting for the train you know is coming instead of running after every shadow on the tracks. And here's the shift you need to make. Winning is not making money every day. Winning is following your plan every day. If your plan says you only trade when 5 specific criteria align, and today only 3 are present, then not trading is a victory. The impatient trader measures success in dollars. The patient trader measures success in avoided mistakes. If this approach resonates and you want more insights that actually move the needle instead of just sounding good, go ahead and subscribe. Hit the notification bell so you don't miss the next one. We're building something different here at Trader's Bible, and I read every comment you leave. Now, back to it. Think about the psychological damage impatience causes. Every premature entry that turns into a loss chips away at your confidence. Every unnecessary loss forces you to trade harder just to recover. And when you trade harder, you trade worse. This is the spiral that destroys accounts. Ruthless patience stops the spiral before it begins. It's a protective barrier between you and your worst instincts. But patience isn't natural. It has to be trained. And it starts with absolute clarity about what you're waiting for. If you don't have a clear, well-defined trading plan, you cannot be patient because you won't know what you're looking for. Your mind hates uncertainty. Without a plan, it will convince you that any opportunity is good enough. When you know exactly what a perfect setup looks like, you can reject everything else with confidence. The clearer your rules, the easier it becomes to sit through the noise. A futures trader named David was mentored by one of Chicago's best pit traders in 1995. The mentor told him, "If you can stand on this floor all day and make 0 trades, you're ready to be a professional." At first, David thought it was a joke. Why would you be a trader if you don't trade? But after blowing his account twice, he understood. The mentor wasn't teaching him to avoid trading. He was teaching him to avoid bad trading. That year, David focused purely on waiting. He let dozens of potential trades pass. When his exact setup came, he executed with precision and size. By year-end, his win rate improved by over 40%. Not because his strategy changed, because his patience did. The real test of ruthless patience comes during drawdowns. When you're losing, the temptation to make it back quickly is overwhelming. The impatient trader doubles down, chases high-risk trades, tries to force the market to return what it took. The patient trader accepts the drawdown, steps back, and waits for the same high-quality setups that made them profitable in the first place. This is counterintuitive, but it's why patient traders survive and grow while impatient ones burn out. Patience is also the foundation for scaling. If you're impatient with your 150s, you might flip it to $300 quickly, then back down to $75 just as fast. If you're patient, you might only grow it by 5% in the first month. But that 5% compounds. Your small, steady gains build a stable base that can handle larger positions when opportunities expand. One of the hardest parts of ruthless patience is dealing with the what-if moments. You skip a trade because it didn't meet your rules, and it ends up being a massive winner. The impatient part of your brain screams, "See, you should have taken it." But here's the truth that saves careers. A good process will sometimes let winners go. That's not a flaw. That's the price of long-term survival. Your job is not to catch every winner. Your job is to take only the trades that fit your edge. The market will always offer more opportunities. Missing one doesn't matter. Breaking your rules does. And this brings us to the third framework, which is where most traders completely fall apart: emotional detachment. Here's the brutal reality. The market doesn't care about your feelings, your hopes, or your desperate need for a setup to work. It's not your friend. It's not your enemy. It's a mirror that reflects back the truth about how disciplined or undisciplined you are. And most traders lose because they tie their emotions too tightly to each individual trade. They treat every entry like it has to work, like it defines who they are. But no single trade matters. What matters is the collective result of hundreds of trades executed with consistency, not desperation. When you risk $3 and lose, it stings. But when you let that sting push you into revenge trading, you've already lost the mental game. You start seeing setups that aren't there. You start forcing positions just to erase the pain. The market punishes that every single time. You have to become emotionally detached from the outcome of each trade. You have to see a loss as just another data point in the process, not as an attack on your identity or a threat to your future. I've seen traders with brilliant technical skills fail because they couldn't handle the emotional side. One had a win rate over 60%, but his losses were twice as big as his wins. Why? Because the moment a trade went against him, he panicked. He'd close early or flip the position entirely. He knew the chart was telling him to stay patient, but his emotions were screaming at him to act. He wasn't losing to the market. He was losing to his own reactions. That's why emotional detachment isn't optional. It's a survival skill. Think about flipping a coin. You know that over 100 flips, it will land heads roughly 50 times. You wouldn't panic if the first 3 flips were tails because you understand probability. Trading works the same way. If your strategy is profitable over time, a single loss doesn't matter. 10 losses in a row don't matter, as long as you stay disciplined and keep following your edge. But if you let emotions take over, you abandon that edge. Suddenly you're gambling instead of trading. In 2008, during the financial crisis, a trader I knew personally made over $400,000 in 6 months shorting bank stocks. His strategy was solid. His timing was impeccable, but after a sudden reversal cost him $50,000 in one day, he lost control. He started doubling down on bad trades, chasing moves that had already happened, trying to make back what he lost. Within 3 months, all his profits were gone. He later told me it wasn't the market that ruined him. It was that he couldn't emotionally accept being wrong. He needed the market to make him feel right again. And the market doesn't do that. The mindset you need is one of complete detachment. When you place a trade, you've already accepted that you could lose that money. You're not trading to be right. You're trading to execute your plan. If the plan says cut the loss, you cut it. If the plan says hold for the target, you hold. There's no room for, maybe it will turn around thinking. That's emotional attachment speaking, and it's the enemy of consistency. The best traders treat each trade like one grain of sand on a beach. One grain doesn't define the beach. One win or loss is irrelevant in the big picture. They don't celebrate wildly when they win. They don't spiral into frustration when they lose. They focus on the process, not the outcome. Because the moment you start judging yourself based on a single result, you're handing your emotions the steering wheel. And emotional drivers crash. Detachment also means removing ego from the equation. Your trades are not you. Losing a trade doesn't mean you're a bad trader any more than winning one makes you a genius. Ego pushes you to prove yourself to the market, but the market doesn't care about proving points. Ego keeps you in bad trades because you don't want to admit you're wrong. But the market rewards those who can admit they're wrong quickly and move on. A humble trader who cuts losses without hesitation will always outlast a proud trader who refuses to let go. Your job is not to predict the market. Your job is to manage risk while letting your edge play out over time. Once you understand this, losing trades stop feeling personal. They just feel like business expenses. Imagine you own a restaurant. If you have to throw away a few meals because orders got canceled, you wouldn't close the whole restaurant in frustration. You'd keep serving, knowing the overall business will be profitable as long as you work the system. Trading is identical. Losses are the cost of doing business. There was a small-time trader in Chicago who started with $2,000 in 1995. He traded options and barely broke even for the first year. But what set him apart was how little he cared about each individual win or loss. His entire focus was refining his process. He treated every trade like a test of his discipline, not his intelligence. By 2001, he had turned that $2,000 into $3 million. When asked how, he said, "I stopped needing the market to make me feel good. I just needed it to follow the math." That's emotional detachment in its purest form. You can train this. First, define your risk before every trade. If you're willing to lose $3 on a trade, accept that loss before you even click buy or sell. That way, when it happens, it's not a shock. It's just the plan playing out. Second, focus on the next trade, not the last one. Win or lose, the last trade is dead. The only one that matters is the next one you take with discipline. Third, keep your trading size small enough that losing doesn't cause emotional damage. If you're so nervous about a trade that you can't think clearly, you're risking too much for your current emotional maturity. When you strip emotions out, something shifts. Your decisions become sharper. You stop chasing. You stop hesitating. You follow your rules with precision. And the market starts rewarding that precision over time. Now here's where it gets interesting, and it's the part that protects everything you've built. Relentless adaptation. Markets are living, breathing beasts. They change, they evolve, they punish those who think they've figured it out and reward those who adapt without ego. This is the mental edge that separates traders who survive from those who get wiped out. It's not about predicting the future perfectly. It's about adjusting when the present changes unexpectedly. The traders who grow small accounts into something life-changing understand that nothing is permanent. Not trends, not volatility, not patterns. In fact, the moment you become overconfident in a method, the market often shifts in a way that makes it less effective. And here's the trap. Your brain craves familiarity. It wants you to keep doing what feels comfortable. That comfort can kill you. In 2008, when the financial crisis hit, traders relying on stable long-term positions found themselves in chaos. The ones who adapted quickly, switching to short-term trading and tight risk control, didn't just survive. They thrived. They didn't waste time blaming the market or insisting it would go back to normal. They acknowledged the game had changed and immediately changed with it. Relentless adaptation means you never marry a single strategy. You treat your approach like a tool, not an identity. If the tool is no longer useful, you put it down and pick up another. Many traders fail because they confuse consistency with stubbornness. Consistency is applying good principles over time. Stubbornness is refusing to change when conditions demand it. This mindset requires killing your ego every single day. Ego makes you think you're smarter than the market. Ego tells you your analysis can't be wrong. Ego whispers, "Hold the trade a little longer. It will turn around." Ego wants to be right more than it wants to make money. A trader with relentless adaptation doesn't care about being right, only about being profitable. Look at nature. Species survive by adapting to their environment. When the environment changes faster than they can adapt, they go extinct. Trading is no different. Your strategies, risk tolerance, even your trading schedule must evolve with market conditions. Some months you trade aggressively because volatility is high and opportunities are abundant. Other months you trade rarely, preserving capital because setups aren't clear. You adjust without guilt, without frustration, without fear of missing out. One of the most powerful ways to develop this is to treat every market condition as a teacher. When the market trends, it's teaching you momentum, discipline. When it ranges, it's teaching you patience. When it's unpredictable, it's teaching you risk control. The worst traders complain about bad markets. The best traders study them, adapt, and extract lessons that make them sharper for the future. The key is making adaptation a habit, not a reaction. If you only adapt when forced to, you're already behind. You should be testing new methods, new time frames, new risk models before you even need them. That way, when conditions change, you're not scrambling. You're simply switching gears. It's like a fighter who trains in multiple martial arts. No matter what opponent steps into the ring, they have an answer. Marty Schwartz, famously known as Pitbull, was already a legend in stock index futures trading in 1995. But when he realized the game was changing, he didn't cling to the old ways. He expanded his skill set, studied different markets, adjusted his risk profile. That ability to evolve kept him profitable, while others who refused to change lost everything. Relentless adaptation also means embracing discomfort. Growth happens when you willingly step into uncertainty. If you only trade setups that feel safe, you limit your potential. The market will always find ways to challenge your comfort zone. Sometimes it changes speed, sometimes direction, sometimes it just grinds sideways for weeks. Your job is to move with it, not against it. And here's what most miss. Adaptation isn't just about technical strategy. It's about your mental state. Some days you feel sharp, focused, ready. Other days you're tired, distracted, emotionally charged. The adaptive trader recognizes this and adjusts position size, frequency, or decides not to trade at all. They adapt not just to the market, but to themselves. This is the final piece because without it, all the discipline, patience, and resilience you've built can be destroyed by one stubborn refusal to change. The market isn't obligated to reward your favorite setup forever. It doesn't care how well your strategy worked last year. It doesn't care about your opinions. It rewards those who flow with it like water. Flexible, but with force when needed. If you want to turn $150 into something much bigger, you must be ready to reinvent yourself as a trader again and again. Every level of growth demands a different version of you. The beginner learning risk management must adapt into the intermediate trader mastering emotional control. That trader must adapt again into the advanced trader who reads the market's mood almost instinctively. And even then, the adaptation never stops. There will be times when adaptation feels like starting over. That's normal. Every time you adjust, you're sharpening your survival skills. You're proving you're not here for quick wins. You're here for the long game. The $150 trader who becomes a millionaire isn't the one who finds a perfect system. It's the one who becomes a shapeshifter in the face of change, reinventing themselves as many times as necessary to stay ahead. So burn this into your mind. The market owes you nothing. It doesn't reward hard work alone. It rewards adaptability. The trader who wins isn't the one who fought the market and won. It's the one who moved with it so skillfully they never had to fight at all. You now have the 4 cornerstones. The seed perspective that builds respect for capital, ruthless patience that protects you from yourself, emotional detachment that keeps you consistent, and relentless adaptation that ensures you survive when others don't. Master these, and your small account is no longer limited by its size. It's limited only by your willingness to grow. The market is a mirror. If you're rigid, it will break you. If you're fluid, it will carry you forward. Be the trader who bends, shifts, and transforms as often as necessary. That's how you survive. That's how you thrive. And that's exactly how you turn $150 into $1 million. So let's bring this full circle. You probably clicked on this video thinking the secret to turning $150 into serious money was some strategy, some indicator setup, or some hidden pattern the pros don't want you to know. But now you understand the truth. It was never about the strategy. It's about the operator. The millionaire traders aren't special because they found better setups. They're special because they built 4 mental frameworks that most traders never develop. First, they see small capital as a seed that demands the same respect as large capital, because how you treat $150 is exactly how you'll treat $150,000. Second, they practice ruthless patience, understanding that not trading is often the most profitable decision you can make. Third, they've mastered emotional detachment, viewing losses as business expenses rather than personal failures that need immediate revenge. And fourth, they adapt relentlessly, treating their strategies as tools to be switched out rather than identities to be defended. Here's what separates you from where you want to be. It's not time and it's not money. It's your willingness to respect the process when it feels too slow, to wait when everyone else is acting, to accept being wrong without spiraling, and to change your approach the moment the market demands it. The traders who scale from small accounts to life-changing capital aren't the ones who cracked some code. They're the ones who became the type of person the market can't break. Your $150 isn't the problem. It never was. It's your training ground for the discipline that will carry you through every level after this. So the real question isn't whether you can turn $150 into $1 million. It's whether you're willing to become the trader who can.